if you look at the average access of the population in West Africa to electricity is one of the lowest in Africa and arguably in the world. And then, so it is even said that because of the lack of electricity, it takes away a lot of what GDP could be had.
If it's dark, you can't work, you can't shop, and you certainly can't make things. That's one of the major problems facing the West African region, which is one of the most energy poor in the world. I spoke to MacDonald Goanue. He's the Director of Research and Strategy Planning at the ECOWAS Bank for Investment and Development. We talked about the issues around electricity generation and also about why African countries get penalised in the international debt markets. We also discussed the challenge faced by ECOWAS Bank after 3 members split away from the bloc, leaving it with hundreds of millions invested in countries which have severed their ties. But we started with electricity infrastructure.
With electricity access, there will be 24-hour economy. Okay, what do I mean? That means the shops will be open throughout, small businesses will thrive, they will be able to sell their wares in some countries. And I like to use my country, Liberia, as an example. A business will probably close around 5 o'clock, 1700 hours. Because by the time there is sunset, they will be dark enough and people will want to go home. But with electricity, you see that market stores, small businesses can continue to sell probably until 10 o'clock in the night, which then will mean that those who are working the day will have opportunity to even go. Small shops and things.
But one of the key challenges the bank faces is access to affordable finance. Most development banks are backed by strong, stable, developed economies. But ECOWAS Bank is not investment grade, which means its costs are much higher. And that problem has been exacerbated in recent years by the security situation and now by the uncertainties around the foreign and economic policies of Donald Trump.
If we can look at a realignment of the international financial architecture, it could be something that is good. Because we as the way rating agencies have their methodology, the methodologies tend to punish most African countries because of the environment in which they live. They find themselves. So they look at security, they look at a couple of parameters that at the end of the day, in the grand total, in the grand scheme of things, will then come together to impact how much a bank or a country can have competitive access to loans and facilities. Take, for example, we over the last few months, we have been trying to go to the Eurobond market to raise some funding. But because of the geopolitical situation, because of the tariffs in the United States, the cost of the funding have gone up, given the fact that we are a non-investment grade bank. So we are waiting to see how the market cools down, then we can go.
One thing that would help, Goanue pointed out, is a stronger domestic market so that countries and ECOWAS could raise money locally. That would require greater integration within the region, with its 400 to 500 million inhabitants, nearly the same size as the European Union. However, he warned against rushing into a single currency, pointing out that even the EU, with all its economic prowess, struggled when it tried to integrate nations which hadn't yet completed their homework.
We have to take care of a couple of things. For example, what is our level of intra-regional trade, which is around, some people say it's as low as 8%. It's between 8 and 12%. So having a single currency is not just for the name, because what are you doing with a single currency? You have to be trading and what have you. Before the European Union converged, they had up to 77% intra-regional trade, which makes a lot of sense. But if you don't have the same fundamentals, okay, so there will be issues with you down the road. I think the leadership of ECOWAS is playing cautious because they want to be sure that they don't want to go into an arrangement tomorrow that will collapse.
Finally, we talked about the split in ECOWAS since Burkina Faso, Mali and Niger left the organisation early this year. That created an issue for the bank, but unlike many other institutions, it decided to retain its staff there, and both sides have an interest in continuing to collaborate, with Burkina Faso and Mali up to date on their rescheduled payments, and Niger making an effort to get itself back on track.
We are an ECOWAS institution, and of course, normally we will have to respect ECOWAS protocols and the rest of it. But what we have done is to use persuasion to our leaders and explain the rationale for us wanting the three countries to remain or that we do business there. For example, 23% of our portfolio is found in these countries. We are exposed to the level of about over 200 million in those countries. So our abrupt departure from there will not be, propitious for us. So we have asked the governing authorities of ECOWAS that, look, we want to continue to do business in this place.
The ECOWAS Bank is performing an important task in improving the lives of those who fall within its remit. But as Goanue pointed out, raising capital is tough at the moment, and the bank does not have a large pipeline of projects coming up. Those conditions in the short term don't look like changing, with the security challenges and geopolitical challenges meaning it's going to be a difficult time for the next several years.